is Ryan Miller, and for the past 15 years, I've helped hundreds of people to raise millions of dollars for their funds and for their startups. If you're serious about raising money, launching your business, or taking your life to the next level, this show will give you the answers so that you too can enjoy your pursuit of making billions. Let's get into it.
If you've ever wondered how to sell a business or how to build one the right way that gets you a massive valuation, then you're going to want to tune into this show where my dear friend Jonathan Braband and I talk about investment banking and how to optimize your company's valuation and sale. Let's get into it. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend Jonathan Braband. Jonathan is the managing director at Transact Capital. It's a boutique investment banking advisory firm that helps founders to sell their businesses for top dollar. See, Jonathan has done over $750 million in deals, of which he wrote all about it in his new book, $100 Million Exit, Your Roadmap to the Ultimate Payday. So what this means is Jonathan is the guy you call when you're ready to sell your business and ride off to the sunset in that shiny new Lambo. So Jonathan, welcome to the show, man.
Hey, thank you so much for having me, Ryan. I love the show and the community you've built. I'm excited to be here with you tonight.
Yeah, it's awesome. It's been a wonderful community. We're in over 100 countries, and we're certainly honored to have someone with your caliber and your background and your wisdom to come on the show and talk about selling a business, which is a subset of private equity, but it's really a big part of all businesses. You don't have to be a private equity carnivore to do this like Jonathan, but he is here to support people, and he's agreed to share some of his cheat codes. You're going to want to hang in to the end where we really open it up. As long as I'm nice, maybe I'll say pretty please to see if he'll open up on some of his secret sauce on how he's able to get it done. But before we get into that, maybe you can help me understand how did you even become an expert in this area?
So this is what I've done my entire career, Ryan. I got into investment banking right out of college, but had a taste of the M&A bug even before that. And back in high school, I started a small business, had a few employees, a few different crews. And when it came time to go to college, rather than just shut it down and sell off the equipment, I actually sold the business itself. I had my first M&A deal really before I knew what that meant, but found a buyer for the overall business, sold to one of my employees, and was able to take that, buy my first car, actually. So the M&A bug bit early, as did the entrepreneurial spirit. And I took that into undergrad, got a degree in finance, and went to work as a first-year analyst at a boutique M&A firm in Richmond called Harris Williams & Company. Back in the late 90s, we were a scrappy, small firm fighting against the much larger firms out there and learned the trade from the best in the business. I ended up moving from a couple large firms to a couple smaller firms, but this is all I've done for over 25 years is help business owners when it comes time to sell.
Wow, that is phenomenal. And so for 27 years, and I think you mentioned before offline that you've done over 750 million in transactions. Is that right?
Yeah, I think that's a pretty good estimate. It adds up over time.
Yeah, exactly. So doing that, no doubt, you definitely learned a few lessons along the way. Some of you, I'm sure you enjoyed. Others you probably want to forget about, like the rest of us.
Correct.
But, with that being said, just looking forward to what we're doing today. So that was a wonderful start. And many of you listening are just starting investment banking or aspire to be, or maybe not at all. But it's good to know one day you'll be working with them and exactly how does it start in the DNA of some of these people, which I like to call carnivores. All right. So that being said, that's a compliment, by the way. I consider myself in that audience with you. So let's talk about some of the stuff that you're doing today. Just talk about Transact, what it does, and where you add value.
Absolutely. So I'm a managing director, as you mentioned, at Transact Capital. We're an M&A advisory firm based in Richmond, Virginia. I lead transactions for the firm. We deal with clients with between, call it 10 and 75 million in revenue. So we're on the sell side. So we have clients who own their businesses and are looking for an exit. They come to us and we help them through that process. And so there are about 20 of us in the firm, and we do transactions all over the country and all different industries as well.
Brilliant. You took those 27 years and all that MD experience that you've got, maybe some of those early analyst days too, and you've pushed it all together in a book called $100 Million Exit, Your Roadmap to the Ultimate Payday. Maybe you can walk me through a little bit on such a cool title of a book, but maybe walk us through like kind of person would even want to read the book like this. Maybe just color that out a bit.
Absolutely. So I'd say the primary audience are business owners anywhere in their kind of corporate life cycle, whether it's early on, they're just starting a business, whether it's later on, and they're thinking about, actually getting serious about an exit or taking on, an investor. I think it's also pretty helpful though for young professionals who are looking to get into investment banking, attorneys and other people who interact with investment bankers, because there's a fair bit in there around sort of the process that investment bankers run for their clients, some of the pitfalls that I've seen over my career. But the main gist of it is taking a hard look at large transactions, $100 million and above, that have been really successful for those sellers, and pulling from them key success factors, things that made those transactions particularly successful, and distilling them down to hopefully very valuable advice that could be applied to business owners of any size. Business owners that have startup, that have 5 or 10 million in revenue, 50 million in revenue, whatever it might be, can glean some of these insights from $200 to $300 million transactions that I've been involved with that really aren't in the public sphere. These These are not things that are reported on. It all kind of happens behind closed conference room doors. And so I thought it'd be helpful to share that in the book.
I love that. One of the key things for those of you that are listening to conversation with Jonathan and I, a lot of people aren't really sure, like, when do I contact an investment bank? When is a good time to sell my business? There's a lot of questions when you're looking to retire. Do I pass it off to my kids if that's even a possibility for you? Do I, is there a succession plan? Do I sell it? Do I go public? And where do I even find people that can cut a check for, 10 times EBITDA or 2 times, whatever your multiples are? There's a lot involved in exiting your company, which I'm not telling you anything you don't know, but I'm speaking to the rest of the world. This can feel like a daunting task, but Jonathan is here screaming from the top of his investment banking mountain, Mount Olympus, is to say, you know what? You don't have to do all of this alone. There are a lot of companies. The other myth that's out there is to say, well, yeah, like investment banks only work with these like SpaceX and buying Twitter. And, that while that is true, likely, I don't know who was involved in those deals, but it's not just those deals. There are smaller areas that you can still get that investment banking experience and have someone literally hold your hand through this whole thing, handle it, and really be a champion and advocate for you. And that's a big part of the sell side part of investment banking. Would you agree?
Absolutely. I would, whether it's me or someone else like me, because it's going to sound a little self-serving, but business owners should not sell their business on their own. There is just too much at risk. It's a one-time, typically it's a once-in-a-lifetime type event. Most of us would use a realtor to sell our house, and businesses are much, much larger, much more valuable, and much more complex than a house. So trying to go it alone and negotiate, particularly with a sophisticated serial acquirer on the other side of the table without an advisor on your side of the table is not recommended. And to your point, there are M&A advisors of all kinds for all different size business. And so there's not a situation where there isn't one that can help you. Someone can help you for sure.
Nice. So on that full spectrum, whether you're a smaller business all the way up to as big as you want to go, this industry can help you. You just need to know where to contact them. And so with that being said, I'd love to let's really start chopping it up on some of these cheat codes. This is investment banking, making billions exclusive here, where we're really going to talk to a very experienced investment banker, nearly 3 decades of working in this industry and helping people to sell their companies. You can walk us through. Let's just start with the basic. Like, how do you even know when the right time is to sell your business? Because I know there's a lot of people out there that are thinking about sales, but they're like, is anyone going to like this? Are they going to buy? Maybe you can share with us, how do you know when the right time to sell your business is?
Absolutely. It's a great question. That's one that we get very often. And so to boil it down, I do try to take some pretty complex topics in my world, and in speaking to business owners who haven't been through a sale process before, I do try to make them pretty accessible and basic. And so there's 3 things to look out for when you're thinking about the right time to sell your business. And that is the health of the M&A markets itself, the health of your industry, and how your company is performing. And I'll circle back to those very briefly. So just like you'd want to sell your house in a hot real estate market, you want to sell your business in a hot M&A market. And that is, for better or for worse, the M&A market has been hot with a few minor exceptions, 2008, 2009. Maybe like 3 weeks during the beginning of COVID, where things took a pause. But for a lot of fundamental reasons around the private equity capital that's been raised, around the pressures on strategic buyers to grow faster than they can organically, there is a ton of capital out there looking for good companies to buy. And so the M&A market, the first 3 markers, is pretty much a check plus most of the time. And interest rate increases like we've been seeing recently really don't slow that down. That's the overwhelming demand is stronger than the interest rate environment. So the second one is the health of your industry. And so you want to sell your company when your industry is on an upturn. There's a general feeling that the industry that you're participating in and the drivers of it at a macro level are over time are going to sort of win out over any one individual performer. And so it's a lot easier to sell an average company in a hot industry than it is to sell A+ superstar company in an out of favor industry, because buyers are assuming that at some point that the industry dynamics are going to catch up with that high flyer. And so you can think about typical cyclical industries like oil and gas is a great example, where when oil is high, any business that touches the oil fields delivers people to and from anything that can tie into oil and gas when that market is hot is going to get a better multiple. But when oil prices are low, you can't give away an oil and gas related business. And so most of my clients aren't in industries that are that cyclical, but I use that as an example where you want to take a look at your industry and make sure there are no lurking big threats on the horizon, no big environment or legislation changes that are around the corner, something that's going to really disrupt on a negative side, your industry. And if the foreseeable future seems positive and strong and your industry is generally healthy and growing, then that's what you're looking for from the industry perspective. And so the thing to remember with your company is you want to come off of a period of strength, but you've got to leave something on the table for the next buyer. They're buying the future, not the past. So we can't sell businesses for outsized multiples when they've peaked and have started to decline. Like if you've run it out and now it's starting to plateau or decline, then it's great that you made all that capital and all that cash during those years, but you're not going to get a strong multiple for it because buyers have got to figure out a way to get it back on a growth trajectory. Using a baseball analogy, we'd like to sell businesses in like the seventh inning. We got to have something left in the tank for the buyer to get excited about, to give them a reason to want to pay up for that business. And so that's probably the one that business owners miss the most, is that they kind of hold on too long, and the business starts to plateau. They start to lose focus, or maybe they start to slow down in their excitement for the business or their ability to put in the hours like they did before. Business starts to suffer a little bit, and then you're kind of selling off your back foot. You want to be in a more stronger position with growth ahead of you.
Man, I love that. A question that I hear a lot, and I'm hoping you can help me out, is there's a lot of players. You alluded to that early on in this conversation, so I'd love to unpack that. Is there's a lot of players and a lot of people who can help entrepreneurs, business owners, or even fund managers to sell companies. Now, on one side, we have investment bankers at many different ranges that they can support you. But you also have this group of business brokers who claim they can help, and I'm sure they do. I've never worked with one, but there's a lot of them. I assume they're quite good at what they do as well. What's the difference? And like, how would people kind of gauge, should I work with an investment banking firm versus a business broker to help me sell a company? Maybe if you can unpack the difference between those two, it would really help our fans.
Absolutely. Great question. So in one sense, they're all the same. They all help business owners sell their company. And that's where we are alike. I'm in the investment banking side. And then there's the business broker world that you mentioned as well. Business brokers help sell their clients' businesses in a different way than investment bankers do. And they work with a different type of companies, specifically smaller companies. So business brokers typically work with businesses that are up to 5 or 6 million in revenue, that typically are looking for an individual buyer. So someone to come in and buy the business and run it. So like an individual buyer. And the process by which business brokers find buyers for their type of business, these types of businesses, is very similar to a real estate listing. So they will take an engagement exclusively, they'll write a little summary about it, and then they'll post it on a website anonymously in terms of the company name and identifying details, like bizbuysell.com is probably one of the largest ones. But there's others as well, Empire Flippers or Micro Acquire. And we'll have a listing price that they've worked out with their client. And their process then is to reach out, to push that out to people that they know might be interested, to field inquiries from the internet. And essentially the first buyer that can be qualified, that comes close to meeting or exceeding that asking price, you sign them up and you try to get the deal done. And so it's a very kind of passive approach. You put it out there and you see what comes at you, and you react on a one-off basis based on the responses you get from that listing. That is an inexpensive, relative to investment banking, it's more inexpensive process. And it works very, very well for businesses in that size range. That is the best way to sell 5 million in revenue business. Investment bankers take a different approach. They work with larger companies and they take a more proactive approach. So when I work with a client, there's no listing price, there's no listing on bizbuysell.com, there's nothing out in the public domain, even anonymously. We write a much more in-depth offering memorandum because our businesses are typically more complex, they're larger. And then we do research on the types of buyers that might be interested in this business: strategic buyers, financial buyers, private equity groups that already have a holding in the space and are looking for add-ons to it. And we can unpack that a little bit more. But our team comes up with a finite list. It could be 20 people, it could be 200, and I say people, it could be 200 names of companies or investment firms that would be interested in this particular client. Once the client has signed off on the book that we wrote on their behalf and that list of buyers, we proactively call each one of them and only them. So there's nothing that's out in the world beyond us one-on-one reaching out to each of those groups. And we simply run an auction process where those that are interested sign a non-disclosure agreement. They get the book that we've written that the client approved. They all get the exact same version of that. At a certain date, they have to put in first round bids. We present those to the client. They decide which of the first round bids they'd like to move on to the next level, which is a in-person meeting with the management team. And then those all happen within a very small period of time. They get access to additional information, but again, all the same information. And then ultimately, each of those finalists puts in a final bid. We negotiate amongst them on behalf of our client. We pick one and we help them close the deal. So the difference is you've got a big funnel process that we're running, all based on a timeline, based on everyone having the same amount of information, having the deadline set at the same time, so that at each point, our client is acting with as much of feedback from the market as they possibly can. And you can really maximize the value that way. All that work, though, costs a little bit more from an advisory perspective than the business broker approach, but it makes sense for these larger transactions. And so they're both perfectly suited for the types of clients that we and they work with.
I love that. So thank you for walking people through. So the difference between a business broker, typically where the line is, according to what Jonathan's talking about, is saying if you're 5 million-ish range or less, probably a business broker is fine. It's very light touch as far as the services you receive, but it gets the main thing done, which is selling your company. It likely can get the main thing done. That's where you guys converge. Where you guys diverge is everything else almost. And so where you diverge is saying, well, it might be a little bit more, but if you're above the 5 million for sure, then maybe investment banking might be a better thing for you. As your business grows, your revenue grows, things are a little bit more complex, and you're going to need some pros like Jonathan and his team to be able to get it done. I love that. What else have you found when people are seeking to sell their company? What other piece of advice, maybe a second piece of advice that you can share with people understanding, say, like, how do you even arrive? So some people say your company is selling 3 times revenue or 5 times EBITDA or what, all of these different, what we call valuation multiples. Can you speak on that? I mean, walk us through just on a high level, how are companies even valued?
Yeah. I mean, Ryan, you're hitting on these are the two questions that I get asked most often. When's the right time to sell? We just covered it. And what's my company worth?
Oh, there you go.
Literally, that's what everyone wants to know all the time. So I'm glad we're tackling this. So look, the issue or the challenge is that private companies are difficult to value. And it's very subjective. There's an art and a science to it. Public companies are easy. Like every day, every minute, you know exactly what Apple is worth. You can look at what their stock price is. You can see how much debt they have, how many shares outstanding. The market's valuing that company daily. Private companies does not have that type of transparency by design. And it doesn't have that kind of liquid market to create a daily precise value. And so that's where people like myself, and there actually are, we do it at Transact, but there are also business valuation firms that specialize only in the business valuation side of it and not the actual M&A process that I described. That can be helpful for estate planning or divorces or partner buy-ins or buyouts where you need a precise dollar value for your business to affect some kind of transaction that you might be working on internally. So private company valuations, art and science. The science part of it, let's start there first, because that's probably the most familiar to your listeners. So there are essentially, the way I was taught, I think it's still true today, there's 4 main valuation models that buyers use to value private companies. And then there's an asterisk 5th one that I'll mention. But the main 4 are comparison to public companies. So this is looking at what public companies that are in your industry or related to your business, what they're trading for, revenue multiple, EBITDA multiple, other multiples, and gleaning from that through a few adjustments, what your business in your sector is trading for. The second one is comparison to previous transactions. So this is like looking at comps for a real estate transaction. What have houses like yours sold for in your neighborhood in the last couple of years or 6 to 9 months? We do the same thing with businesses. So we can look at private company data where they have transacted, they've sold a business. We have access to, and other investment banks have access to PitchBook and other places that track what financial information you can glean. It's not perfectly transparent, but they track some key statistics that allow us to get a sense for what buyers are paying for private businesses in your space. That's only as relevant as how similar those targets are to your business. So we help maybe make some adjustments for size or other things. And then there's 2 more, the discounted cash flow model, which we all may have learned in finance class and undergrad. It's just looking at a string of cash flows out into the future that your business represents, discounting them back at a risk-adjusted rate based on how risky that set of cash flows is viewed to be by the buyer. And that can give you a value of that essentially stream of cash flows. And then the last one is a leveraged buyout model, which uses the same projections from the DCF model, but looks at it in a different way. It looks at how much debt and equity could a private equity group put on the business to acquire it. And then assuming that set of projections, be able to repay the debt and exit the business to give them a return that they're targeting. And so you basically can back into, if you know what the return that they're targeting, you've got a set of projections, you can back into how much equity they can put in to make that all work. That plus the debt that the market would put on that business at that time that it can sustain gives you the stack to make an enterprise value.
I love that. So the 4 things on the science is comps, or sometimes we call them comparables of public companies. How did the ones that are as close to your business, how are they trading on the public markets? Given you're a private deal, it may not be quite one-to-one. Also the differences in your businesses. We're just saying, hey, we got to get a sense of the value of this company. The whole context of this part is how do you value a business? Now you mentioned, I just want to touch on this because you mentioned it, you went past. So I think our audience will really like this. So you mentioned one of the areas that you can go for information on either figuring out what recent transactions were valued at, as well as the comps, those first 2 on the science. You mentioned PitchBook, which I love. PitchBook is great. Preqin is another one that people can use sometimes. Where else can people find that type of information? That's
a good topic to start to develop a relationship with an investment bank on an informal basis and start to get some feedback from them as you start thinking about, kind of early pre-interviewing of an advisor that you might use down the road. But on your own, looking at public companies that have been acquisitive in your space, probably the easiest, most accessible way is to look at their investor presentations, which you can find on their websites. And it'll talk about if they've been acquisitive, go to their last annual investor presentation and skip to the section. It's usually PowerPoint easy. It's meant to be very, easily digestible. Go to the section on acquisitions and read about what the acquisition they made and why they made them, and they may talk about some general valuation metrics that they used in that business. A more arcane way, but for those who are brave enough to do it, is you can delve into the SEC filings, and public companies have to file a number of reports with the SEC. The most common are probably the 10K, the annual report that they have to do every year, and the 10Q, which is their quarterly, much shorter version, but an update on the quarterly. Beyond that, though, there's one called the 8K, 8-K, and that's the one that we look for. They typically need to file an 8K when something important from a transaction or business related standpoint happens in between a Q. A large acquisition a public company would make, they would file an 8K, and you can download that and read all about the benefits of it, the risk factors that they saw, and financials of the target, and if it's large enough, how much they paid for it. So investor presentations, the easier kind of way to do it. Delving into the SEC filings, looking for 8Ks is the other way.
Man, I love that. So you mentioned there's an art and a science to valuing your business when you're getting ready to sell. We went through, there's LBO models, and whether you do it on your own, if that's you, or you hire Jonathan to do it. Then there's also, you got to know, like, what's the market appetite? How is it tolerating this business? So how much value does the market put on it? Because we all believe our company's worth an infinite amount. But unfortunately, we got to work with the market and let them dictate the price, at least to a certain degree. So that's great and all. And that's the science. That is literally how you dive in, you model this thing out, you get it valued. But what about the art? I'd love for you to touch a little bit on the art that you mentioned on valuing your company for a sale.
Absolutely. So I think that's really where good investment bankers serve their clients, is the art side of it. So when I talk about art, I talk about how your advisor positions the business, how it describes the business, how strong or compelling of an argument it can make on your behalf to each type of buyer around the fit that exists between your business. There's the one-on-one personalized selling that we do on behalf of our client that changes a little bit differently depending on the audience, the buyer audience that we have for any given time. It's things like, how important is your business to that acquirer's growth strategy? Are they building a puzzle for which you are a missing piece? And if you're one of the last missing pieces of a puzzle they're trying to build from a corporate strategy standpoint, that could be really attractive for you and make your business very valuable because they're trying to do something much larger and they're willing to overpay for that last linchpin that makes it all work. So that's an exceptional position to be in. How impactful would the eventual announcement of this acquisition be for that particular company's stakeholders? So are their shareholders looking for an acquisition and they haven't had one for a while and they need to make one? Is it a geography, a client base, a technology that they've been talking about wanting to get into that now they can finally check the box that they accomplished that by acquiring your business? These are all some of the special things that drive the art side. So the best way to think about it, and wrapping up, is if we were to run a broad process and call 100 different buyers and get first round bids from all of them and lay them out based on value, you'd have a bell curve, and you'd have the smaller end value buyers, kind of tire kickers that are hoping to get a good deal. Those are dismissed immediately. You have the meat of the bell curve, where most of the quantity of buyers come back in. Those are all the people who are running those same 4 miles I talked about, with largely the same assumptions, seeing the same public companies, and coming up with basically the same market-based valuation for your business. That's sort of like the standard. This is what those models spit out. But then on the other end of the bell curve, that you have spike bidders, and they're the groups that you really want to try to uncover and cater your message to and attract them into your process, because they know those same 4 business valuation models. They've run them as well, but they have special, unique reasons why they're willing to pay more than that. And so our processes are designed to find those spike bids and pull them into the fold and help negotiate them off of each other to get sort of an outsized valuation and really go beyond the 4 business valuation models that everybody can run.
Yeah, man, that is phenomenal. Really, the science is just modeling it out and saying what's going on and what do we think it's worth. And the art is really, as Jonathan alluded to, is just how well are you or the investment bank or business bro, whoever it is that's really advocating to sell this business, how are they positioning the business? And so you can have buyers that are positioned who will love the business just because it's a great cash flowing business and that's it. The other ones are saying, actually, there's a product here that we could use with our product. And so there could be a strategic alliance as well. They're not direct competitors to you, but they are a strategic buyer. So you just have cash interested buyers, right? Which, let's be honest, that's probably most. But then every once in a while, you can have this category of people that'll say, it just makes sense with our existing product ladder or product stack, acquiring this business and the revenues, but also the IP and all this stuff. That makes sense for us. In fact, you might be able to unlock a premium. I don't know, maybe call me crazy. Not everybody values it the same way. So someone who sees that your component will 10x their components if they own yours, then yeah, the price they're willing to pay might be higher from a strategic investor. But the point is that working with a professional, they're able to to position your company through the art of selling your business. They're able to position it so that even if you get a valuation, let's say it's $1 billion, you went unicorn, everyone's excited at this valuation. Well, you got to pull it off. And somebody might be willing to pay $1.5 billion because it's just a strategic fit. Other people will pay just under $1 billion because it's like, yeah, I kind of like it, whatever it is. There's a lot of churn and a lot of things that you need to go through. Who better to have than an investment bank on your side to help you in selling that? Now, I mentioned we're going to talk maybe about 3 things. So I'm hoping you've got a third thing in the chamber, a third cheat code we can talk about. We talked about valuing the company, selling the company, and knowing when to sell the company. But there's another thing. So that's a lot of that is external. What about the internal factors specifically when you're selling? Because when I was a CFO, we were literally going through this. We were selling the company and working with an investment bank, and it was a phenomenal experience. So I highly recommend it with anybody. But this is the stuff that I focus on. How do the people who are operating the business now, how do they increase the value so they optimize their exit price? What are some of the things that you've seen to help companies to get ready to sell by increasing their value?
Absolutely. So that's the goal of most of my clients, is to try to maximize value. And those that are smart enough to get in touch with me early on, when they're still several years before they want to exit, they have a window there where they can really have a significant impact on increasing the value of their business before they come back to me and we go to market with it. And if you think, probably the simplest way to think about it is that DCF model. A business, even for buyers that are strategic in nature, as you mentioned, it's still essentially a stream of cash flows discounted back at some type of risk-adjusted rate. Now, synergies play into that with the strategic buyers. So their cash flows for the same business could be higher because of the value that what they bring to the table and what your business brings to the table creates 1 + 1 = 3. But it's still a stream of cash flows. It could be only what you've projected or additional synergies that the buyer brings to the table. The main way that most clients think about increasing the value of their business is just making the cash flow streams bigger. So that's an easy one. The bigger we get, the more valuable our company is. And not only is the size of the earnings itself directly relevant to valuation, larger businesses typically get slightly higher multiples because they're seen as safer. So a 10 million in EBITDA business is going to get a higher multiple than a 5 million EBITDA business, in addition to the fact that it's got twice as much earnings, if that makes sense. What I think clients often overlook is the second piece, is that risk-adjusted rate. The thing that I try to work with clients on is to understand that if they can reduce perceived risk in their business that a buyer would see, that buyer will put a lower risk-adjusted discount rate on that same stream of cash flows, and the business will be worth more. 2 sets of cash flow, one very risky and one very safe. The safer one will be valued higher. And so what are perceived risks that buyers may see in your business, and how can you address them? So this is things like, the easiest one is recurring revenue. So people talk about recurring revenue as being very valuable. It's because it is perceived as being less risky, because you've got a recurring base of subscribers in many cases, or other types of recurring revenue where you don't have to start from scratch each month, each quarter, each year looking for new project-based revenue. You've got a built-in engine that is driving recurring revenue. So that's where recurring revenue businesses, because they're less risky, have a higher multiple. And sometimes you even hear about revenue multiples for software-related businesses, SaaS businesses that have high degrees of recurring revenue. Even for businesses that don't have that, though, other areas of risk involve diversification of customers. So customer concentration is a negative thing and is seen as risky from a buyer's perspective. Even if it's a customer that has been there for 20 years, will be there for the next 20 years, you think they're great. If they're like half of your revenue, it's going to be tough for a buyer to get comfortable with that, because there's a chance that when they walk out the door, half of your business goes with it, if that were to ever happen. So diversification of customers, same with suppliers, making sure that you've got a diversified supplier base. A lot of our customers will have our clients will have a primary and a secondary supplier that they work, maybe 60% from one, 40% from the other. So there's always a backup supplier on key materials that are maybe more difficult or have longer lead times in the market. Depth of leadership team. So this is one that business owners sometimes struggle with, where so much of the business still rests on the entrepreneur's shoulders, and they don't have a team that has responsibility spread out across multiple individuals. And that can be seen as risky for a buyer to buy a business and put a bunch of money into the pockets of the person who still does a lot with the business, and one day may say, I've got all the money I need, I'm going to walk out the door. And what is that buyer left with? Not as much. And so working with your leadership team, developing a good leadership team, and having a succession plan in place for business owners who want to exit is vital to getting a good multiple. So, we talked about industry dynamics, having positive industry dynamics, having a compelling value proposition, and being able to articulate that to buyers of your business. Why do customers love you and keep coming back to you? Why do they like the product or service you offer? Those are all types of things things, the more you can make the business feel like it not dependent on any person, customer, product, individual product, all these areas of diversification around all these different angles, it will be seen as less risky and more valuable.
I love that. As we wrap things up, is there any final closing remarks, like how people can reach out to you? Anything at all that you'd like to mention to our fans?
Absolutely. So I'm on LinkedIn, Jonathan Brabrand. You can search for me there. Transact Capital is our firm. I'm on the website there. The book that you were kind enough to mention is out on Amazon and Barnes & Noble, The $100 Million Exit, available in paperback and Kindle, wherever you are in the world.
Perfect. So as we wrap things up, just to synthesize, just know when the right time to sell your business is. The second thing that Jonathan left us cheat code is just learn the art and science of how your company is valued. And then finally, we talked about where he unpacked is learn how to increase the value of your company before the sale. You do these things and you too will be well on your way in your pursuit of making billions.
Wow, what a show. I hope you enjoyed this episode as much as I did. Now, if you haven't done so already, be sure to leave a comment and review on new ideas and guests you want me to bring on for future episodes. Plus, why don't you head over to YouTube and see extra takes while you get to know our guests even better. And make sure to come back for our next episode where we dive even deeper into the people, the process, and the perspectives of both investors and founders. Until then, my friends, stay hungry, focus on your goals, and keep grinding towards your dream of making billions.